We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. The goal of this series is to help you better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. The Institute is a professional association, advanced education provider, and standards body for financial advisors, investment consultants, financial planners, and wealth managers who embrace excellence and ethics. Through our events, continuing education courses, and acclaimed certifications, which include the Certified Investment Management Analyst, Certified Private Wealth Advisor, and Retirement Management Advisor certifications, we deliver Ivy League and practical education for investment and wealth professionals. Hi, I'm your host, Bob Powell. I serve as the editor of the Institute's Retirement Management Journal. Today, we are talking about retirement income strategies. This is a big topic, especially right now with all that is going on in the world, a health crisis and an economic crisis. And many of your clients may be experiencing some anxiety around their retirement plans, their retirement strategies, and particularly around their retirement income. Our guest today is Nick Halen, a corporate vice president with New York Life. So welcome to the podcast, Nick.
Thanks, Bob. I appreciate the time today. Happy to be here.
Pleasure to have you. So before we get started with the gist of our conversation, do you mind giving our listeners a brief overview of your background and what they're about to hear?
Sure. So my team and I at New York Life are largely responsible with leading the strategy and the research functions within the retail annuities business at New York Life. And on the research side, we're primarily focused on is really two things. So part of what we do is product agnostic research on broader retirement industry themes. So things around healthcare and spending and other things that most if not all retirees deal with on a daily basis. We do a bunch of analysis, bunch of research, and we write and ultimately publish white papers on those topics. What we also do is a lot of, being in New York Life, being very focused on income, doing a lot of research and analysis on quantifying the value of our products. So, again, a lot of modeling, a lot of analyses, and trying to show the uplift in actually implementing a retirement income strategy that uses insured assets as well as traditional assets.
So could you talk just a bit about the research and how it came to fruition? I know that as editor of the Retirement Management Journal, we had published some of the early work that you and your team had done from many years ago about this topic.
That's correct. Yeah. So I'd say about 10 or so years ago, we came up with a retirement income framework, right? And how it came about was we were frequently hearing from the field that, listen, we get it. We understand there's qualitative benefits to SPIA and DIA and income annuities in general. But there was two questions we kept getting, over and over again, right? The first was, how do I show the uplift to a client versus doing something else or doing nothing, right? So I get those qualitative benefits, but how do I quantify the upside benefit of actually implementing these into a retirement income strategy? And the second part was, how much of an individual's assets or how much of their portfolio should we be allocating towards these solutions? So as you can imagine, those are very difficult questions to answer, especially on a one-off basis. It's very, the true answer is it depends, right? There's a lot of factors that go into that. So essentially what we did is to help address these questions we were getting and to help acknowledge the fact that planning and allocating assets in an accumulation construct is infinitely different than a decumulation construct. We created this framework, which we call the Efficient Income Frontier, or EIF for short, which at its core is it's a portfolio optimization framework that accounts for an individual's outcomes and what they want to accomplish in retirement. And we do that by including both traditional and insured assets.
So we all know that retirees face a different set of financial risks and are often concerned about different things than those investors who are still in the accumulation phase. Can you tell us a little bit about how retirees differ and why these risks are so different for them?
Yeah, sure. And I think that's the key. It's the key word when you're talking about the difference between saving for retirement and then ultimately, spending portfolios down when you get there is risk, right? And we look at it as if you look at modern portfolio theory, and if you look at just accumulating assets in general, the key risk that you face is investment risk, right? I have a 30-40 year period where I want to accumulate assets, and the number one risk is, will I get the returns that I need to save the amount that I want, right? And that's really the core and key focus in the accumulation phase. However, once you get to decumulation, things completely change, right? So you still face that investment risk. You still need returns to you still need to generate returns to be able to accomplish what you want to accomplish. But there's a host of different and new risks that are very retirement specific that you don't face when you're saving for retirement. And what we found is there's two risks in particular that drive a significant percentage of the outcomes in retirement. When I say outcomes, I'm referring to, will I or will I not run out of money? And the two risks that have the biggest impact on that retirement are sequence of returns and longevity. And sequence of returns is so important. And there's been numerous studies. In a way, Powell and Michael Finke and others have done some research on this as well, which is very much in line with what we found, is that returns 5 years prior to retirement and then the first 10 years of retirement in particular are most important in terms of how your portfolio is going to end up in the long term. And the reason for that is if you have a poor series of returns early on, combine that with the fact that you're spending down your portfolio, any subsequent gains really, they're basically accruing off a smaller base, and it's difficult for your portfolio to eventually catch up. Now, you don't have that issue when you're, it's not really much of an issue when you're, let's say, you're in your 20s, because you're not spending that money down. So if the market declines 10%, first of all, you don't have that much in the way of assets, so it's not a big hit to the portfolio. And second, you're not spending it down, so you're leaving it untouched, and it's not that big of a deal if you just hold tight. You don't have that luxury in retirement, right? Again, you need that for income, and presumably right at retirement is when your portfolio is its largest. So a 10% hit to your portfolio all of a sudden is a very meaningful thing, right? So it's a very retirement specific issue. In terms of longevity, we typically talk about it as a multiplier risk, right? I think at the end of the day, what makes decumulation a lot harder, amongst other things, is that you don't know what the planning horizon is. When you're accumulating assets, you're saving for retirement, people generally know when they want to retire. They may be off by a few years here or there, but very rarely is it, I want to retire at 65, but I'm going to end up retiring at 40. Decumulation is very different, right? It could be a 5-year, 10-year, it could be a 40-year time period of when you're planning for it. So you need to account for the fact that it's a very realistic possibility that you could be living, meaningfully past life expectancy. There's stats showing out there that a healthy 65-year-old couple, there's, I think it's roughly 50% chance that at least one of them lives to age 90 to 95. So you have to account for these facts, and you have to account for this risk and the fact that it is a multiplier of other risks, right? So if you live longer, the longer you live, like the more exposure you have to the inflation risk, the more exposure you have to a health event that could, lead to some unforeseen costs. So again, sequence of returns and longevity are the two key risks that we found in particular really need to be addressed when doing retirement income planning.
So one of the things that we hear a lot about in this particular environment is it being a low interest rate environment, and how that can be particularly challenging to fund retirement with traditional assets. And any thoughts about that as it pertains to, say, longevity?
Yeah, and I think that's absolutely right. I think, the low interest rate environment has made the cost of funding retirement spending higher, right? And annuities are not immune to that by any means, right? Like payout rates are to a certain degree tied to interest rates, right? So they are impacted by that as well. But I think, the key difference and the key benefit of an income annuity, especially in a low interest rate environment, is that they provide mortality credits, right? And essentially it's a risk pooling mechanism, which says that you can essentially subsidize, the income of individuals who live a long time with the income of the individuals who didn't live a long time. So if you're looking at funding retirement with an income annuity versus just like a bond, let's say, generally speaking, you're always going to be able to get higher income with an income annuity at, assuming similar credit quality. You'll be able to get higher income out of an income annuity because of these mortality credits, which a bond can't provide.
Right, so, nor stocks.
Right. Right, right. And the reality is, in a low interest rate environment, it's expensive for everybody and it costs more for everybody to fund retirement, but you get that additional benefit with an annuity that you can't get with a traditional asset.
Okay, so let's pivot a little bit and talk about, again, current conditions. And in today's environment, there's a lot of volatility with the global pandemic. There's still a lot of uncertainty. And while advisors may no longer be talking clients off the cliff, so to speak, how should people think about sequence of return risk today?
Yeah, sure. So when we talk about sequence of returns risk, we essentially mean the risk that portfolio returns early in retirement are negative, or you have poor returns early on followed by positive returns later on, versus an alternative scenario where you just retire, you have positive returns followed by the potential for negative returns later on. So a poor sequence of returns is basically like you retired and within a few years of you retiring, you had some down years in the market. And
okay,
if you look at the macroeconomic environment right now, I think sequence of returns risk is really, it has to be front and center for anyone doing retirement income planning. And I think what we've seen earlier this year is, especially in the equity markets and I guess just in life in general, what we found out is that the one thing that's certain right now is uncertainty. And I think there's a lot of things that can derail financial plans very quickly. And I think making retirement income plans based on what's happened historically is a dangerous exercise, right? And just assuming like, oh, equities have historically returned 10%, bonds have historically returned 4%. Like, if you allocate your assets this way, you should be okay with a little bit of flexibility. I think what we're seeing is that's not the case. And I think we're in a very different environment now than we've ever been in. And I think if you look at, aside from the volatility with the election, the volatility in the markets with the pandemic, if you look at, all the big asset managers' expectations for equity market returns over the next 10 years are, at historic lows, right? So I think going forward, the expectations about returns in the market are pretty tempered, right? No one's expecting next 10 years to be this like economic boom and a significant windfall for investors. So I think the fact that not only are average returns going to be, maybe below historic levels over the next 10 years, if you combine that with the fact that there's a lot of different things going around this that can cause a lot of volatility, you have to be careful and you have to make sure you properly plan for handling a poor sequence of returns over the next 10 years. And you're seeing that in where flows into assets are going, right? And I think a lot of what we're seeing from investors is over the next 10 years, it's not about alpha, it's about protection and preservation, right? I think especially those who are at retirement, they kind of have to take that approach, right? They have too much to lose, they're too close to retirement, and a few bad years early on can completely derail financial plans. And in the annuity space, you're seeing rising demand for products, these structured or buffered products that give you downside protection. You know what your downside is. You can sleep at night because you know what that's going to be. I'm not going to, come back to my advisor a year from now, my portfolio is going to be down 40%. I know what my downside is. I know I need equity exposure, but I can sleep at night and I know I'm preserving what I need to effectively get through retirement. So I think managing that sequence of returns through not only like asset allocation, but also through being flexible and not only your spending, but also like your retirement plans, like maybe working another year if you have to kind of to weed this out. I think it's really important because the returns over the next couple of years are probably going to be volatile in one direction or the other.
Right. So when you talk about sequence of return risk, you talk about the returns that I guess occur the 5 years prior and say 5 to 10 years after. How hard is it for folks who are say 5 years away from retirement to think about sequence of return risk while they're also thinking about capital preservation? Is that a bit of a quandary where people have to start de-risking their portfolio, so to speak, in the 5 years prior?
Yeah, absolutely. That's a tricky part because the reality is, and I would say that's not only necessarily a pre-retiree concern, because even in retirement, like generally speaking, most advisors and most clients know that they do need equity exposure, right? Like they need equity exposure because to support their spending needs, a lot of people who are living off the portfolio, they need the returns to basically support that. But you're absolutely right, because it's a quandary, because it's like, I know I need equity exposure. I can't just panic sell and get out of the market. But also at the same time, like, this next 5 years could get pretty ugly. And I think if you look at the pre-retirees, there are products and solutions available now, again, like a structured or a buffered product, that can give you some of that peace of mind, and that, yes, I get equity exposure. There's some cap to the upside, but I do get equity market exposure, but I know what my downside risk is in all these. And again, aside from just the pure like product pitch, I think, individuals who want to retire in 5 years just need to be flexible in how they approach it, right? Nobody really knows what the next 5 years looks like. I think if you ask somebody who was about to retire before the financial crisis, they may have had to make adjustments along the way. And I'm sure the people, individuals who are close to retirement now, like, that's still pretty ingrained in their minds. So I think flexibility is the name of the game. And I think, having some sort of asset allocation approach where, you are getting some sort of protection and some sort of preservation of capital is very important right now.
So I know the research also considers inflation and, as you sort of alluded to a second ago, and withdrawal rate risk. Can you tell me a bit about what you have found there?
Sure. So on the inflation side, I think the reality is we all deal with inflation on a daily basis, right? It affects the cost of the goods that we're buying, but I don't view it as a risk while we're working, because the reality is wage inflation tends to either coincide or even exceed regular inflation. So it's an issue, but it's not necessarily a risk while you're working. However, when you're in retirement, you're spending, you're spending from your portfolio or any other sources. You typically don't have many inflation adjusted sources of income. You obviously have Social Security, but for the majority of, especially in the financial services world, the majority of clients, Social Security is not going to be a huge percentage of their spending. So that's where it becomes more of an issue. And it requires, over time, if you don't effectively manage that, you have to, the only thing you could really do is cut down on spending and cut back where you can, because the reality of life is costs are going to continue to go up. So, again, we view that as more of a retirement specific risk, quote unquote, than while you're working. And the withdrawal rate risk, I mean, the reality is nobody knows what a quote unquote safe withdrawal rate is. We've this industry, we love to talk about the 4% rule and William Bangen's research. And I think, we're at a point where we're hopefully moving past that. I think there's, a unanimous agreement amongst especially thought leaders in the space that, set it and forget it 4% withdrawal rate is not meaningful or feasible these days. So, I think the name of the game, again, for individuals who are spending down their portfolios, it has to be, a flexible approach. And, spending, working with their advisors and financial professionals to understand what a realistic and sustainable withdrawal rate is for portfolios, not just, assuming you can spend 6% when that's not realistic, because you can very quickly run down and deplete a portfolio if you don't, if you're not careful, you don't pay attention.
Yeah. So with respect to income annuities and as it pertains to inflation and also withdrawal rate risk, the research seemed to suggest that the inclusion of an income annuity supports higher equity exposures without increasing the risk profile of the portfolio, and it gives you a better hedge against inflation in retirement. That's such an interesting concept. You want to expand on that?
Sure. Yeah, that's one of the findings of the research, and a little bit counterintuitive, but I think if you think about like inflation hedges, one of the best natural inflation hedges is equities, right? And one of the findings of our research is that actually, we're seeing this heightened demand for, these glide paths towards fixed income investments as individuals approach retirement. But the reality is we found that by incorporating an income annuity into a portfolio, you actually could also increase the equity exposure without increasing the risk of the portfolio, which again is not only a great inflation hedge, it also actually increases the upside potential of the portfolio, again, without increasing the risk. Because the income annuity, having that in there, it's not susceptible to the risk that we've just talked about, right? Like you don't have to worry about sequence of returns when you have an income annuity. You don't have to worry about longevity when you have an income annuity. So you're offsetting a lot of these major risks in retirement just by having this solution in your portfolio, which allows you to take on a little bit additional risk with the rest of it and to improve results overall for the portfolio.
Right. So it does it both on the inflation side and on the withdrawal rate side as well.
Correct. Yeah, and on the withdrawal rate side, I would say, put simply, if you have an income annuity, that'll cover at least a portion of your spending on an annual basis, which means you're less dependent on your portfolio for income. So you don't have to withdraw as much. So you don't have much of that risk or that much concern because you're not as dependent on your portfolio. So you don't have to withdraw as much from it.
So I've read that retirees care more about outcome than returns, with fewer than 10% of pre-retirees believing that earning a competitive rate of return is the most important goal. What does your research say about this, and what can advisors do to help investors achieve their retirement goals?
Yeah, so that I would say there's a handful of surveys that have been done, and we've done them internally at New York Life, but there's also been others, that we've come across, which basically shows a little bit of a disconnect in that if you ask financial advisors if retirees are very concerned about investment risk, almost all of them say yes. Like they're very concerned about investment risk. And in fact, I think there was one that we just came across, a TIA survey was 7 out of 10 advisors say that. But if you ask the actual retirees themselves, it's not the biggest risk for them, and it's actually not that big of a concern for a lot of them. And around 2 out of 10 retirees say that it actually is. And if you ask them what they're really concerned about, it's about not necessarily like what are the returns I'm going to get in retirement? It's, am I going to be able to achieve certain outcomes, right? So am I going to be able to fund my retirement lifestyle? Am I going to be able to leave money to my kids? Am I going to be able to achieve some specific outcome that isn't tied directly to rates of return? And now, the logical question is like, well, if you're an advisor and you're working with clients and you're generating good returns for them, theoretically, they should be able to achieve the outcomes they desire, right? Because you're making money for them. So we did some research on this, and basically what we found is that actually investment returns are poor proxies for outcomes, meaning that just because I'm generating alpha or I'm generating IRR, that doesn't necessarily mean that my client's going to be able to achieve what they want to do. And the reason for that, again, is largely because of, sequence of returns risk, right? Because if you have two portfolios and over a 30-year period, they both, return, let's say on average, 10%. The one that has a poor series of returns early on is not going to have a good outcome, whereas the one who had a good series of returns early on is going to have a good outcome. Like that's the key risk. So not all portfolios, even if they return 10%, are created equal in retirement. It has to do with the timing of those returns. So what we found is that investment returns alone they're just not good proxies for outcomes. So as individuals' mindsets shift from, I'm currently working and saving to now I'm retired and spending, the approach with these individuals has to change as well, right? From an advisor standpoint, you're very focused on generating alpha and accumulating assets. You have to figure out how I can help these individuals best achieve their outcomes once they get to the point of retiring.
And it strikes me that for advisors, this is a place of differentiation. They can add value to their clients by talking about outcomes versus returns.
Correct.
And it also strikes me that having all the tools available to them, whether it's traditional assets or insured assets, is critical, right? Not having just a hammer in the toolbox, but having hammers and screwdrivers and saws and whatever, right, to be able to use the appropriate tool at the appropriate circumstance.
Right, absolutely. And I think if you look at the planning tools out there today, a lot of them, if not most of them, are focused on accumulation, because the reality is accumulation is easier to solve for than decumulation, right? It's like I said, there's a lot of different things to take into consideration when doing decumulation planning. And the reality is it's not easy. But like you said, the more you have in terms of tools and resources, the easier it will be. And the reality is that's why we created this framework, the EIF framework for not only for our career agents at New York Life, but for advisors who work at firms who saw the value in this. We wanted to create a scalable framework that advisors could use to show them how to effectively navigate, all the issues that they're going to come across in decumulation planning, particularly retirement income planning, through the use of a simple, easy to use tool, essentially.
Right. So you talk a little bit more about how you said it was based on the modern portfolio theory. Can you talk a little bit more about that? Yeah, sure. So if you think about modern portfolio theory, basically what it's saying is that, by some assets are by default going to go up and some assets are going to go down. So by holding a diversified portfolio of assets, you could, either increase returns for a given level of risk or reduce risk for a given level of return. And the $1 million question is so which portfolio should I invest in? So what modern portfolio does, it scatter plots like the universe of possible investment allocations. And it looks for the portfolios that are in the top left corner because those are the ones that have either the highest return or the lowest risk. And it creates this efficient frontier. And those are the portfolios that you should never, you should basically be never investing in anything below this efficient frontier because you're either, again, giving up upside or taking on too much risk. And so what we did is we basically took that and we looked at it through a decumulation lens, right? So modern portfolio theory only looks at one risk, which is investment risk, and it has one return metric, which is basically just investment returns. What we did is we completely changed that to decumulation specific metrics. So we're looking at what we call investment risk, which is an all-encompassing risk that includes investment risk, sequence returns, inflation, longevity, and is effectively like the likelihood of you running out of money. So that's the risk metric that we're using. And the return metric that we're using is legacy potential at life expectancy. So basically, what's the probability of this portfolio running out of money? In scenarios where it doesn't run out of money at life expectancy, on average, how much is left to leave as a bequest? And basically what we found is by adding in income annuities to the universe of assets, what we found is they typically shift the efficient frontier up into the left, which is, again, you want to be in the top left of the scatter plot. You don't want to be in the bottom right because that's suggesting low upside and high risk. And basically, again, it was suggesting that adding income annuities improved outcomes for many retirees. And what's also very different and unique about the framework that we've created is ours is outcomes based, whereas modern portfolio theory is expectation based. So modern portfolio theory suggests, how it works is basically, let's say I assume bonds are going to return 4% and equities are going to have, 8% returns. If I have a 50-50 portfolio, that portfolio on average is going to give me 6% returns and then, with some level of standard deviation. So it's very expectation based. We expect returns to be X, therefore, this portfolio is going to get you Y. Ours is very different in that, again, we're taking an outcomes-based approach. So we're actually simulating what's going to happen over, through life expectancy. So we're not just saying like, okay, here's what your return's going to be and here's what the risk's going to be. We're actually testing it. So modern portfolio theory is scalable, meaning that like the universe of asset classes in the efficient frontier applies to every single investor on the planet. Where you fit on that frontier depends on your risk tolerance, whereas there's a different EIF curve for every single retiree based on what they want to accomplish and how they want to do it. And we've essentially made it scalable by operationalizing it into a tool that agents and advisors can use. So I guess one question, a little bit of off script, is as you add annuities into the equation, are you eliminating bonds from the investable universe, or are you still including stocks and bonds in the investable universe and adding annuities to it?
It's a great question, and I would say we're not eliminating fixed. We're not eliminating bonds. Obviously, income annuities would be considered a fixed asset class, although a unique and different asset class. We definitely are not excluding any of the traditional assets. We're just including more to the equation. And to your point earlier, this was a framework that we developed roughly 10 years ago, and over time we've continued to evolve and improve the framework. And while we initially looked at when we initially looked at it, we just accounted for SPIAs, and within our framework, we've incorporated different types of income annuities, so SPIAs, DIAs. We even looked at GLWBs, and we've also even included life insurance into the framework as well. To see, we talk about the value of insured assets kind of holistically, and there's different types of insured assets that can improve outcomes. And over the year, we've continued to evolve the framework to account for more asset classes and not replace any of the existing ones.
Okay. So maybe you could do a deeper dive into how the income annuity improves outcomes and what makes them an important part of the retirement portfolio.
Yeah, and I'd say there's really three key characteristics that make them we say three key characteristics that shift the EIF upward, but the reality is they improve outcomes is what that essentially saying. First is their duration matched to your life, right? Like you can't outlive an income annuity. And there's no other asset class that does that, right? So that, as you can imagine, significantly offsets longevity risk. When you combine an income annuity with Social Security, longevity risk is largely mitigated. Never taken off the table, but it's largely mitigated. The second piece of that is there's no standard deviation, and income annuities are completely uncorrelated with the markets, right? Which is by nature a very good sequence of returns hedge. If you buy an income annuity, you're getting guaranteed income, and it doesn't matter what happens in the equity markets next year. It doesn't doesn't matter what happens with interest rates or the credit markets. Your payout is your payout, and your income is your income. So it's very uncorrelated, and it reduces the risk that you face from sequence of returns. And lastly, as I mentioned before, is they provide higher income than other fixed income assets or, in particular bonds of similar credit quality because of the mortality credits, right? So the payout on an income annuity is principal plus interest plus mortality credit, which is, a sweetener versus, a traditional bond portfolio.
Okay. So I know we just touched on it a second ago about the optimal allocation of stocks and bonds in a retirement portfolio. You want to do a little bit of a deeper dive onto that topic of how income annuities are technically a fixed asset and how it is affecting the rest of the portfolio?
Yeah, I think another one of the interesting findings that we had is that when people are saving for retirement, they typically think of allocations towards bonds and cash as being risk averse or safe investments, right? And that's true, right? If you're invested in cash or in bonds, well, you're not really going to risk much, but you're also not going to get much in return. However, what we found is that portfolios that are heavily allocated to cash and or bonds in retirement are actually the complete opposite in retirement, meaning they're actually much riskier than people think. And the reason for that is if you're just not generating the returns you need to fund spending, like you're undoubtedly going to run out of money, right? Like if you're spending 4% from your portfolio and you're only getting 2% average returns from it, like at some point you're going to run out of money. So there's really a twofold answer to the risk. The risk part of this is that like bonds are a little bit riskier than people think in retirement because A, they don't generate the returns that equities generate, and B, they don't provide the income that an income annuity can generate. So while we're being very clear that we're not bashing bonds and saying bonds don't have any purpose in retirement, they absolutely 100% do. We're saying is that people who are overly allocated to bonds, people who have 80-90% of their portfolio in bonds are actually taking on a lot more risk than they think they are in doing so.
So in the research, it seems that a key finding is that you would ultimately lower the bond portfolio, increase the income annuity, increase the equity exposure. Is that almost the path
Correct.
that someone would likely find themselves on? Yeah.
Yeah, and where we would see the biggest uplift is let's say somebody is like 50-50 stock bond portfolio, and where they were to put like let's say 15% of that into take 15% out of their bond portfolio, put that into an income annuity, and then take another, let's say 10% of that and put it into an equity, put more into equities. You're seeing the obviously the risk of the portfolio is being brought down because of the income annuity, because of all the reasons that we discussed, which allows you to then in turn increase equity allocations without increasing the risk profile of the portfolio versus just the traditional 50-50 portfolio. So that's where we see a lot of uplift in the research we've done is, people shifting some of their money from bonds into both income annuities and then ultimately stocks.
Mm. So you mentioned earlier that folks can use the EIF framework to customize portfolios. Are you finding that that all retirees benefit from annuities, or were there certain segments of retirees who didn't see meaningful benefits from buying one?
It's a great question. So what I would say is when we initially developed this framework, we didn't develop it to create some sort of rigged up annuity sales tool. We wanted this to be as academically and mathematically sound as possible. We've had this, peer reviewed by a number of industry thought leaders, and we wanted it to be valuable. We knew if it was, something that would in all arrows point to annuity, like it's just not real life and it's just not reality, right? So what we found is based on the profiles we've run and what we've looked at, we've really divided retirees into three segments, right? So the first segment is what we call like low income risk. Like these are people who really have no chance of running out of money, and typically who they are is they're a little bit older, they have sufficient assets, and they have a very low spending need. Right, like these people just aren't spending their money. They're never going to run out of money, and frankly, they're perfectly fine just self-insuring their retirement. Right. So then, through this framework, there's no quantifiable like uplift from annuity because they're not going to run out of money anyway. Right. There's things you can do here and there of their asset allocation to maybe improve a little bit on the legacy side, but there's really no uplift from an annuity for these individuals because they're not going to run out of money anyway. On the flip side of that, we have, people who are like much higher income risk, and these tend to be a little bit younger, don't have sufficient assets, and they have unrealistically high spending needs. Right? Again, these individuals are not going to benefit from an income annuity because the only way that they're going to be able to support such a high spending need is investing in ultra risky, high yielding, emerging market stocks. Emerging market international stocks. So, which there's no advisors in the planet is going to recommend. But the reality is these individuals, the conversation is about, okay, like let's get your spending down and figure out how to manage that. And then we can figure out how to allocate your assets the right way. But these individuals, again, like they're not going to benefit from annuity as well because their spending needs are just way too high. The third group who we found benefit a lot from annuities, we call them, constrained retirees. Now, these are individuals who, they have a reasonable likelihood of running out of money. They have a sufficient amount of assets, but, things can go wrong here or there, and spending a little bit too much and having a poor sequence of returns could seriously derail their portfolio, right? They're basically everybody in between who has a very low risk and a very high risk because they're in, and I would like to believe that they're the majority of retirees out there. They've done everything right leading up to retirement, but, poor sequence of returns or living longer than expected could seriously derail their portfolio. And these are the individuals that we see receiving a lot of benefit from income annuities.
Yeah, it's interesting. In the retirement management advisor curriculum, we talk about being overfunded, underfunded, and constrained, and we would probably tend to agree with that assessment that if you're overfunded or a low income risk, you probably won't need that kind of guaranteed source of lifetime income.
Correct.
And likewise with those who are underfunded. But the constrained are folks who are sort of living in that world where if they were to depend entirely on a systematic withdrawal plan, they might outlive their money. They might be subject to sequence of return risks, et cetera. So
correct.
There's some parallels there. It also strikes me too, Nick, that what you've done is created a science around creating an income plan in much the same way that there was a science around creating accumulation plans and basing it on research as opposed to sticking a finger up in the air and saying, I think this would work or not. Yep. Or even things like the 4-box strategy, where people would say, cover your essential expenses with guaranteed sources of income, and to the degree that there's a gap between, say, Social Security and a pension plan, and your essential expense need, we'll fill it with an income annuity. And again, that was a rough cut way of talking about it, but not necessarily as scientific as an EIF.
Yeah, that was the intent. Yep. Absolutely.
Yeah. So there's been a lot of interest in behavioral economics recently, especially given the current market conditions. Does behavioral economics explain the behavior we see in retirees, like underspending at the moment?
Yeah, absolutely. So we wrote a white paper that was published in the investments and Wealth Monitor that I believe it was the Investments and Wealth Monitor, but it basically talked about, in the media, what we're hearing a lot is that, there's this whole undersaving dynamic going on right now, right? And the thought is not enough people are saving for retirement, even those who aren't saving enough. And down the road, it's going to lead to this big issue with retirees who just don't have any money saved. And what we found is that, another, quote unquote crisis is within the financial services industry. Another issue that we're dealing with is this underspending dynamic. What we found is that there's most affluent and mass affluent retirees have sufficient income, have sufficient assets, but they're just not willing to spend it down to get to achieve the lifestyle that they want. Right. So if you ask these individuals what they want to accomplish in retirement, they tell you, I want to maintain a certain quality of life. I want to be able to travel. I want to enjoy myself. And then somewhere along, down the line of needs is leaving a legacy. Right. So you would think that these individuals aren't spending because they want to give it to their kids. They want to give it to their grandkids. But if you ask them, that's more of a nice to have than a need. They want a good quality of life. They've deserved this quality of life, and they have the assets to support it. But something happens, something triggers within them mentally that's like, I planned for this leading up to retirement, and all of a sudden I get there and like that all goes out the window and I become very hesitant all of a sudden. And we found and as others have talked about as well, is that there's behavioral biases and natural predispositions that end up preventing people from spending the money that they can spend to achieve what they want to achieve. And there's a whole host of these biases which we talk about in the paper, which I won't get into detail here. But an interesting finding in all of that research is that this was true of the majority of again, mass affluent and affluent retirees, but there's certain segments of retirees that didn't suffer from these same behavioral biases. And what we found is that generally retirees who have more guarantees typically spend more, right? So Vanguard did a study of this. We've done a lot of analysis on this on the CAMS and the HRS survey data that's publicly available. And what we found is that individuals who have more, insurance of some sort, whether it's long-term care or guaranteed income through annuity or better health benefits, holding all things else equal, spend significantly more than people who don't have insurance. Right. So it seems that these individuals that get to retirement, there's this like predisposition to hold on to what they have and kind of like, go against the plan that they had. And they effectively end up just self-insuring themselves. Right. So they say like, I don't need to spend this. I'm not going to spend it. Like, I'm just going to continue accumulating assets. So what we see is actually most retirees end up continuing to accumulate assets in retirement. Right. So we talk about like going from like a saver to a spender. What we actually see is like you're a saver and you continue to be a saver in retirement, which is crazy. And if you ask retirees, it's not what they want to do. It's just there's something precluding them from acting in their best interest to achieve the outcomes they want. But again, what we've seen is that individuals who have more of these guarantees feel more comfortable spending what they rightfully can spend. And I think going back to the conversation before about individuals with low income risk, they have no chance of running out of money ever, and they're safe self-insuring. Well, there's certainly a case to be made that there is behavioral benefits of an income annuity there, and just basically giving them the freedom and the autonomy to spend the money they've worked hard to obtain. Right. So, the math behind it may not show that, but I think the behavioral benefit to some of these insurance solutions is very, very powerful and very valuable to many retirees.
Yeah, in my experience, what I've found is that there's so much uncertainty around living in retirement, right? Especially around date of death, right? If you knew your date of death, right, maybe you would feel more comfortable about spending, because right now most people don't know their date of death, and they don't know how long their money has to last, and having that guarantee takes some of the pressure off, or eliminates or reduces some of the uncertainty. Right now, as you suggested.
Right. Absolutely.
So we've covered a lot of ground. Anything that we haven't mentioned that we should, or anything that we've already talked about that you'd like to reemphasize?
No, I think this was great. I appreciate the time today, Bob.
Well, I appreciate it too. It's a topic near and dear to my heart, and actually let me ask: how can advisors learn more about the EIF, and is there a tool available for them to use in the greater world?
So we have a lot of there's content on our website that's that's publicly available for advisors, but we also have the tool that we have is, as I mentioned, for compliance purposes, it's only available to advisors at firms who approved it. So I would say if you have interest in using the tool, we can certainly follow up with anyone who has any questions about that, and we can find out if they have access to it. But I will say we also are working on potentially creating a version of the tool that's a little bit simplified, but would live on a website, so everybody would have access to it. So I would say that's the best path is to see if your firm has approved it, and if not, we can find a way to get in touch, and I can help any advisor who's interested with that.
Great. Well, Nick, I want to thank you for sharing your knowledge about this topic. It's much appreciated.
Yeah, thanks, Bob. Appreciate the time.
Thank you for listening to this episode of the Exceptional Advisor podcast series. This episode was brought to you by New York Life. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or on our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. And if you've enjoyed this podcast, then don't miss our Exceptional Advisor webinar series hosted by Tony Davidow, available at investmentsandwealth.org. Stay up to date and have the latest episode delivered straight to you by subscribing through iTunes, Spotify, or wherever you get your podcasts. The Institute stands ready to help you as you navigate these turbulent times with new resources, research, programs, accommodations for candidates, and certificates. For more details on resources available, visit www.investmentsandwealth.org. This material is distributed for informational purposes only and is not intended to constitute the giving of advice or the making of any recommendation to purchase a product. New York Life Insurance Company, its affiliates and subsidiaries, and agents and employees thereof may not provide legal, tax, or accounting advice. Individuals should consult with their own professional advisors before implementing any planning strategies.